At one point in time, Credit Suisse was a renowned banking institution. I remember when I was in college, some of the cream of the crop went to Credit Suisse, as well as some of the larger investment banks on Wall Street. Since the bank's founding in 1856, Credit Suisse grew into a global financial institution with operations in more than 50 countries. Credit Suisse was a recognized leader in investment banking, wealth management, and other financial services. In investment banking, for example, Credit Suisse advised on many high-profile transactions, including the acquisition of Time Warner by AT&T, the merger of Dow Chemical and DuPont, and the initial public offering of Alibaba. Similarly, the bank was a preeminent provider of wealth management services and was known for its expertise in private banking, asset management, and family office services. However, over the last several decades, the tides have turned for this once acclaimed institution. So what happened, and more importantly, how did this happen so fast? There is no single reason for the failure of the bank. The bank's failure is attributed to risky investments, inadequate risk management, legal and leadership issues, and of course the impact of the global health crisis. When it comes to risky investments, two recent ones in Archegos Capital Management and Greensill Capital come to mind. Archegos, of course, was a family office that managed the wealth of billionaire investor Bill Hwang, and it made highly leveraged bets on stocks using complicated financial instruments called total return swaps. Credit Suisse was one of the banks that provided financing and prime brokerage services to Archegos, allowing the fund to take on even more leverage and increase its bets. However, when the prices of these stocks in Archegos' portfolio began to decline rapidly in March of 2021, the banks that had provided financing to the fund suffered significant losses, inclusive, of course, of Credit Suisse. In addition to Archegos, Credit Suisse has also faced losses related to its exposure to Greensill Capital, a supply chain finance firm that collapsed in March of 2021. The bank had provided financing to Greensill, which had invested in risky assets, including loans to companies with poor credit ratings. In addition to these risky investments, which demonstrated a failure in risk management, Credit Suisse also provided limited transparency on its investment and risk exposure, thus frustrating investors, ran ineffective risk models that failed to adequately account for economic shocks or changes to market conditions, had poor internal controls in terms of oversight of its investment activities, and faced cultural issues where there was a lack of accountability for senior executives. Other examples of awful risk management besides the Archegos and Greensill deals included arranging loans totaling $2 billion to three state-owned companies in Mozambique back in 2013. These loans were intended to finance maritime projects, but were later used to buy military and surveillance equipment. Needless to say, these loans were defaulted on, resulting in significant losses for the bank. In 2015, Credit Suisse was fined $135 million by the New York State Department of Financial Services for attempting to manipulate foreign exchange markets. And it doesn't just stop there. In February 2018, Credit Suisse suffered losses of $500 million in its volatility trading unit due to market volatility. In 2017, Credit Suisse's wealth management unit was implicated in a fraud scandal involving a former employee who pleaded guilty to charges of conspiracy to commit money laundering and securities fraud. Credit Suisse was one of several banks that faced legal action in the aftermath of the 2008 financial crisis for its involvement in the sale of U.S. mortgage-backed securities. In retrospect, when you think about all of these examples, it's no surprise why the bank has been teetering on the edge of financial ruin over the last decade. Outside of risky investments and poor risk management in general, the bank has also been plagued with legal issues. In 2014, Credit Suisse pleaded guilty for helping U.S. clients evade taxes and agreed to pay a $2.6 billion fine to U.S. authorities. The bank was accused of helping U.S. clients hide their assets offshore and evade U.S. taxes by using secret Swiss bank accounts. In 2015, Credit Suisse was implicated in a corruption scandal involving FIFA. The bank was accused of facilitating the payment of bribes and kickbacks to soccer officials. Credit Suisse cooperated with the authorities and paid a fine of $47 million to resolve that case. In 2020, Credit Suisse was fined $47 million by Swiss authorities for failing to prevent money laundering and corruption in relation to a case involving a former Bulgarian politician. The bank was criticized for failing to adequately monitor its client relationships and for not conducting sufficient due diligence on its clients. Credit Suisse has also faced legal action related to securities fraud. Credit Suisse is one of the several banks that were accused of manipulating the LIBOR rate, a benchmark interest rate used to set prices for financial products. In 2015, Credit Suisse agreed to pay $84.3 million to settle charges that it had misled investors about the operations of its dark pool trading system. The bank was accused of misrepresenting the extent to which it protected investors from high-frequency traders. And the list of examples goes on and on and on. Usually when it comes to these many scandals, it's demonstrative of a significant challenge in leadership. And this was absolutely true with Credit Suisse as well. In 2020, the CEO, Tidjane Thiam, resigned after a spying scandal involving the bank was revealed. The bank was accused of spying on its former wealth management head, Iqbal Khan, after he left to join rival bank UBS. The scandal highlighted issues around corporate culture and the use of private investigators by the banks. In 2021, Credit Suisse faced backlash over plans to pay out bonuses to its executives and top managers despite the bank's poor performance and its losses it incurred from both the Greensill and Archegos deals. The controversy highlighted issues around executive pay and, of course, accountability. Tidjane Thiam was succeeded by a gentleman named Thomas Gottstein. Now, Thomas Gottstein was also fired several months later for allegedly breaking pandemic rules by attending a private party in Switzerland and violating restrictions on number of people allowed to attend a party during the pandemic. Yes, you can make this stuff up even if you tried. He was succeeded by a man named Ulrich Korner. Ulrich also didn't last long, since the plan he proposed to turn around the bank's performance and improve its reputation failed to garner adequate support due to its lack of detail, execution challenges, and of course leadership turnover. If things weren't already bad at the bank, the internet and social media in particular definitely did not help. In late 2020 and early 2021, there were rumors circulating on social media and other platforms around the imminent collapse of Credit Suisse. These rumors were largely unfounded and unsubstantiated, but they had a significant impact on the bank's stock price and reputation. And that leads us to today, and more specifically, the activities that occurred in the last week. In February, Credit Suisse confirmed the bank's clients had pulled 110 billion Swiss francs, or 119 billion US dollars of funds in the fourth quarter 2022, while the bank suffered its biggest annual loss of 7.29 billion Swiss francs since the financial crisis. The bank attempted to tap investors for almost 4 billion francs. However, this past week, the Saudi National Bank, who happens to be the bank's top backer, told reporters it would not give any more money to the bank as it was constrained by regulatory hurdles. Needless to say, this pummeled the bank stock. This was driven by further sensitivity in general around the banking sector with Silicon Valley Bank, Signature Bank, Silvergate Bank, First Republic Bank, etc., resulting in more withdrawals from Credit Suisse. Now, Credit Suisse is a financially significant bank, an SIB if you will. It has a massive balance sheet, and the bank failure would have significant consequences. To mitigate a bank run, the Swiss Central Bank threw a lifeline of $54 billion to Credit Suisse to show its support and shore up its liquidity. Though there are some analysts who don't think this is quite enough. Now there are talks of UBS buying Credit Suisse. Now remember, UBS actually received funds during the global financial crisis. Credit Suisse did not. And of course, UBS has benefited from several leadership changes at Credit Suisse that have gone over to UBS as well. How the tables have turned between UBS and Credit Suisse, and now there are rumors of UBS looking to take a stake or basically owning Credit Suisse. And most recently, there is a rumor of them offering $1 billion to effectively buy out the bank. It'll certainly be interesting to see what happens within the banking sector and Credit Suisse in particular over the next couple of days and weeks. If you like the contents of this video and stuck around this long, remember to like and subscribe, and I'll see you in the next one.